All right, let's talk robotics. We've got two companies, EKSO and Vicarious Surgical, and they are telling two completely different financial stories. Today, we are going to rip open the hood on their financials and figure out which story the market is actually buying and, why. So, let's say you're an investor. You've got some cash ready to go. You see these two robotics innovators, but when you look at their financial vitals, they honestly look like they're from different planets. One is sprinting like there's no tomorrow, and the other is running a marathon. Our job here is to decode all this data and figure out what is really going on behind those stock tickers. Okay, so let's dive right in. And you know what? We're going to start with first impressions. Because how the market sees these two rivals right this second, well, that tells us a whole lot about the expectations that are already baked into their stock prices. So, in this corner, we've got EKSO Holdings, trading under the ticker EKSO. And in the other corner, we have Vicarious Surgical, which you'll find is RBOT. Let's get ready for a serious financial face-off. So the very first thing any investor looks at is market capitalization. It's basically the total price tag the market has put on the whole company. And right away, the difference here is, well, it's stark. Vicarious Surgical is valued at nearly 3 times what EKSO is. That's a massive vote of confidence from the market for sure, but it also really raises the stakes. And this chart just drives that point home. I mean, look at that. RBOT has a commanding lead in what the market thinks it's worth. This is our first major clue. So the big question is, why? Why is the market betting so much more heavily on Vicarious Surgical? Let's dig in and find out. Okay, so to really get why there's such a big valuation gap, we need to pop the hood and look at the engine of these companies. We're talking about their cash and their debt. And believe me, this is where the story starts to get really interesting. So what are we looking at here? Two absolutely critical numbers for every single share of stock. Cash per share. Think of that like fuel in the tank. It's how much actual cash is backing up each piece of the company you own. And clearly, RBOT has way more fuel. Then on the flip side, you've got total debt per share. And that shows EKSO is carrying a little bit of a heavier load of debt for each of its shares. And here, you can see what that cash advantage really looks like. For every single share out there, Vicarious Surgical is just sitting on a whole lot more cash. And that is a powerful position to be in. It gives them a bigger cushion, more firepower for R&D, for growth, and, for weathering any storms that might come their way. But here's where the plot thickens. Both companies are in growth mode, right? That means they're burning through cash. They're spending more than they make to develop their tech. That's totally normal for tech firms. What's not so normal is the scale of it. Vicarious Surgical is burning through cash at over 5 times the rate of EKSO. That's not a campfire, my friends. That's a bonfire. So here's the crucial point. While RBOT has more cash in the tank, its engine is running much, much hotter. They are spending aggressively. EKSO, on the other hand, is operating with a much lower cash burn. This is a classic tortoise and the hare scenario, isn't it? One is sprinting and the other is just pacing itself. Okay, let's switch gears for a second. It's not just about the money a company has, it's also about who's in control. The ownership structure can tell us a ton about investor confidence and who's really calling the shots. Now, before we look at the numbers, let's quickly talk about free float. What is that? It's just the percentage of a company's shares that people like you and me can actually buy and sell on the open market. The rest are closely held, meaning they're kind of locked up by insiders, founders, or big institutions. For EKSO, the picture couldn't be clearer. Almost 95% of its shares are in the free float. That means it's a company that's largely owned by the public. Its shares are widely out there, available for trading. And then you look at Vicarious Surgical, and it is the complete opposite story. A massive 44% almost of its shares are closely held. This is a huge deal. On the one hand, it can signal that the insiders have immense confidence. They've got a lot of skin in the game. But on the other hand, it means way fewer shares are available to the public, and that can affect trading and really concentrate the decision-making power. All right, we have looked at valuation, cash, spending, and ownership. Let's bring it all together now on a final scorecard and see exactly how these two very different strategies stack up against each other. So let's put it all together. EKSO, that's our tortoise, right? It's moving steadily with a much lower cash burn and wide public ownership, but it is carrying a bit more debt on its shell. Vicarious Surgical is the hare, rocketing forward with a huge valuation and tons of cash that's backed by insiders. But it's burning through that fuel at a really incredible pace. What we really have here are two completely different investment ideas. and neither one is inherently better than the other. An investor who's really focused on stability and a controlled burn rate might lean towards EKSO, but someone chasing that explosive, high-risk, high-reward kind of growth, backed by confident insiders, they might find RBOT way more compelling. And that brings us to the final question, doesn't it? The data gives us two very clear narratives, one of lean, steady stability, and one of aggressive, cash-fueled growth. In the high-stakes world of robotics, the question for any investor is simple. Which story do you bet on to win the race? Thanks for digging into this with us.